Welcome to Multiple Perspectives. I'm David Lofgren. Today, we're diving into an emerging trend in multifamily investing, single-family rentals, and build-to-rent, or BTR, real estate development, as new opportunities for wealth building. As economic conditions shift and the demand for quality rental housing increases, investors are looking beyond traditional multifamily assets and exploring BTR communities and ground-up development as powerful strategies for long-term growth. Joining me today is Vikram Raya, a former cardiologist turned real estate investor and high-performance coach. As the founder of Viking Capital, Vikram helps high-income professionals grow their wealth through multifamily and real estate investing. And through Limitless MD, he coaches physicians on achieving financial independence. With an 8-figure net worth and deep experience in multifamily syndications, Vikram has been at the forefront of identifying new opportunities in the market. Today, we'll explore why build-to-rent and development are becoming major investment trends and how they compare to traditional multifamily assets and how investors, especially busy professionals, can take advantage of these opportunities. Vikram, welcome to Multiple Perspectives.
Hey man, David, thanks for having me.
You've built a career by advising professionals, high net worth professionals, like especially physicians, on developing strategies to transition from these sort of high earning but very time intensive careers into a more entrepreneurial approach to life and to wealth building. Some of what you preach is the value of real estate investing, and particularly investing in multifamily real estate. There's a strategy that you talk about, the build to rent strategy. And I think most independent real estate investors are familiar with multifamily. It's a place where a lot of folks start off, but oftentimes we tend to think just in terms of like a value add strategy. Buying something that's pre-existing, maybe a building with 8 units or something, doing some light remodel, and then releasing them, or sort of applying a mark-to-market strategy. Can you talk about this build-to-rent strategy, and why this is something that you're interested in and think is has a potential for success?
One of the mandates, if you're in the real estate industry, is you can't be stuck on dogma. You have to be flexible. You have to be adaptable. And what worked in the 2000s may not work in 2010s, and what worked in 2010s may not work in the 2020s, and so forth. So, but that being said, I've also seen people diversify too much, and they lose focus completely. Where they start in a real estate firm, maybe multifamily, then they do adjacent activities such as BTR, but then they start, hey, let's do senior housing. Then they do student housing. Then they go, oh, self-storage. And then let's do RV parks. And then, oh, crypto's not too far away. Let's do some crypto mining, right? And so I've seen, friends and colleagues, unfortunately, go too broad. But I've also seen people just stay so in their lanes that sometimes they have to sit out market cycles and wait for the next cycle for that particular asset or niche that they're in to come back. And so we're of the mindset of, is there an all-weather strategy, David? Is there a strategy where, we can still be relatively core in our expertise and mastery of what we know, but add, expand into slightly adjacent markets that can allow us to play different strategies in different market cycles? And so that's hence why the BTR development we're going to chat about a little bit today. So BTR, initially, I wasn't sure about it. I didn't understand it. I mean, it seemed like a subdivision that people just rented. I didn't get the whole excitement around it. But then I started looking at the smart money, and I'm using smart in quotations. These are more institutional, big-time players trying to get into it.
Sure.
And what it did, it legitimized that asset class a little bit. And I remember, I think it was 3 years ago, I think CBRE, one of the biggest real estate brokers in the world, they actually finally got a BTR expert, a BTR broker that only focused on BTRs, and they had figured out how to do BTR debt, and I think it's also known as SFR, which is single family rentals. BTR, I'm sure there's a few other acronyms that they use, but that's the one that we ended up going with. So then we explored it. We tried to underwrite it. We thought, hey, where's the value add, like you were mentioning? And it's really a different business model. And so we studied it in depth, and really, what's driving this is this. Look, it's still unaffordable, if you probably would agree with me, to essentially go and buy homes for most people.
Right.
And so if that's the premise, people are expanding what they want, though. As renters, they're using their dollars as voting, and they're saying, hey, we want bigger spaces, we want lawns, we want more amenities, but we don't necessarily, want to maintain that ourselves. And so that's why, the single family rentals, one-offs, that someone buys in a subdivision, that's still there, but people are looking for more of this organized thing. They want property management. They don't want to, mow the lawns. They don't want snow. They want to take care of someone to do the snow removal. And these are also great for people who are downsizing. These are older individuals who already have had a home, but they don't want to give up that home life, but they want to keep the maintenance lower. And so we're noticing larger living spaces, yards, a community feeling without the burden of home ownership. That's what's attracting people to the BTR space. The second thing is, at least in this market right now, we're noticing some value in the sense that, these builders who build these things, they're not necessarily managers. And so when they sell that, there's an opportunity to lease it up at a higher premium and to run it more efficiently, because we're in the management game while they're in the building game.
Right.
And so that's some of the value add is more of the operational value add, and we're buying at a good basis. So those are the reasons why we've entered this space.
So I'm curious, it sounds like the place that you plug in is post-development. You're coming in, you're saying, okay, we're going to be able to achieve some efficiency in the way that we are planning to manage this space. But I think a lot of real estate investors would say, okay, I was thinking about buying a rental property. Maybe I was thinking about buying a quadplex or something. You're telling me now I need to buy a community of single family homes? Like, how do you think about approaching that potential? Particularly if you're not, let's say, Blackstone or KKR or some massive institution, how do you actually get access to that?
So, David, I think your company, Equity Multiple, does a great job of giving access to the average investor, which is phenomenal. And we try to do the same at Viking Capital. But if I was these investors, I wouldn't do it as either or. I would say, hey, look, if I have a real active interest in real estate, there's probably things within my scope of capabilities that I'm going to go after. Maybe I will take down a quad myself with a couple of friends, and I'm going to start getting some active income. But I'll also invest perhaps in another group who has access to these larger communities, and I'll get some passive income that way. And I'll peek over their shoulders, learn what they're doing, get some knowledge as well, and improve my ability to be an investor over time, maybe in bigger deals. And I think it's the best of both worlds, learning to be, active here, passive here, even other ways where I call it being actively passive, where let's say you and friends and other groups want to come in, and maybe you have enough capital to make a sizable impact. You can come in as an equity source, and that model is called sort of being a fund of fund.
Sure. Right. Okay. So now I think, I know that you speak with a lot of physicians. You yourself are a physician, retired if I'm correct. And
so successfully unemployed, I call it.
Yeah. Well done. I think a lot of physicians who are looking at this kind of thing are thinking, there's got to be, I need a method of assessing whether this deal is worthwhile. I've spoken to a lot of physicians, medical professionals on the podcast and elsewhere that say, once you're in the profession, it's not uncommon that you'll, be speaking with another, someone else who's a little bit further along in their career, and they'll say, listen, man, I got this great syndication. You got to come in on it. This is a guaranteed deal. And then you hear these horror stories of folks who don't have a lot of experience, who maybe don't understand the right questions to ask, trusting their friends and their colleagues, and learning the hard way that there's, there are real serious questions you have to ask before you decide to place your hard-earned money into an investment like this. How do you counsel physicians, who are trying to figure out what are the right questions to ask? How do I know that a partner is the right one for me to go in on a deal like this with?
So one of the things is, I guess, honesty, transparency, and longevity. And I'll address each one in a second. So honesty is really just, look, no group out there has been perfect. we've made mistakes. I'm sure Equity Multiple and other groups have out there. I mean, everyone's human. There's no crystal ball, and you are gonna, you are not gonna hit pro forma every time. I'm just gonna be very transparent there. Second is, do you have a team? Do you have a methodology? Do you have a way to get yourself out of a challenging situation and obviously be investor centric along the way? Meaning, if you think about playing this as a long-term game, like I'm going to be in real estate for 50 years, then you're like, you know what? I'll do whatever it takes to make sure my investors are taken care of and the partners in the deals, and then obviously we will focus on ourselves as well. But if you do it that way, people won't leave you. They want to stay with you because you've just been so transparent, authentic, and forthright in your communications and how you operate. And it's really about integrity. And the last way is longevity, right? If you be in the industry long enough, you're going to go through market cycles where things are going to be amazing. You just throw a dart on a property, and of course, everyone's going to 2x their money, to where there's going to be challenges where the whole industry is suffering. And that happened 2 years ago, right? With the variable rate situation. If anyone bought any deals in 21, maybe 22, yeah, they're going to have some challenges just because, at least in multifamily, the only way to get those deals financed, because the agencies were not participating essentially, was some kind of variable rate deal. So it's really, hey, how are the groups that are handling those adversities? How are they dealing with that? And how are they sharing that information with the current investors? So I would say to the people out there, look, no deal is bulletproof. So let's say you invest in Tesla or in Nvidia. There's an opportunity for you to, lose half your money depending on what happens with the stock market volatility. So people seem to forget, it's not just real estate. There's other asset classes. Same thing with cryptos. Now everyone's darling, but if you just remember, just 2 years ago, crypto was like, oh my God, I would never invest in that again. So there are cycles to everything. Even in businesses, people thought, oh, let me invest in all these businesses. And now, there's a boom in people investing in businesses or franchises, but some of those have been challenged as well. So I would say it's follow Warren Buffett's rule. Number one, only invest in something you actually understand. So number one is invest in yourself. I would say the ROI, there's a 30x ROI investing in yourself. So if you're a physician, you're an investor, you're a high income earner, you're an entrepreneur, and you want to first do something, invest in yourself, meaning invest in education, invest in learning that asset class or in that investment thesis. Number two, start small, 25K, 50K, whatever that is. I mean, that may be big for some people, but for some people, that's usually an entry level investment. And usually it's the minimum investment for most people. Make sure you understand it, talk, ask questions, get feedback, look at the quarterly reports. If there's investor meetings or conferences where you get to meet with the GP or the investor relations team, that's great. Read the white papers. I mean, again, you guys do a great job producing those. So I think that's great. Then it's like, okay, how do I start up leveling within that asset class now that I understand something? And then be keenly aware of what's going on in the macroeconomic situation. And then once you're participating, if you want to get even more active, see if there's ways where you can either be a key principal or partner or a minority partner in one of these deals, and that way you're getting even more equity participation. And so it's a graduated, measured, calibrated approach. And I would say, if you're going to learn about mobile home parks, don't just jump to self-storage or, don't jump to a different alternative. Just really stick to 1, 2, maybe 3 asset classes and 1 or 2, 3 maybe sponsors and get comfortable with them.
Yeah, and something that we see oftentimes is that the sponsors that have the most success are the ones who are the most specialized, right? You learn a specific asset class, you learn a specific sort of niche market or investing strategy, and that becomes, once you've learned a few times, you go through a few cycles of that and you think, okay, now I'm actually able to look at a deal with a little bit more scrutiny, a little bit more information. And like you say, investing in yourself pays such a strong dividend. I feel like physicians in particular are folks who are self-selecting for, you've already proven to yourself that you know how to invest in yourself, right? Like that is, you have to do that to become a physician. You mentioned sort of the cyclical nature of some of these markets. In the built to rent market in particular, how are you thinking about the sort of cyclicality of these investments right now? Would you say this is, blanket a good time to go into this, this market? Is there sort of a method by which you assess where we are in the market cycle, or where, maybe when it's a good time to
Yeah, I
invest
would
in
say
a
the biggest
specific
threat
market?
to BTRs, David, would really be, if I had to think about it, I think the biggest threat is when interest rates really drop, then maybe people will actually rather buy than rent. And I think that could be and that's probably true for all rentals, right? At some point, if it's so affordable to buy homes, then people may choose to rent more than they may choose to buy, sorry, versus renting. I think that's part of it. I don't see that kind of environment for a little while, at least. It's again, supply is limited. I think I was listening to Marketplace, NPR's show, and I think the latest home builders report is saying I think there's about 1.5 to 2 million units shortage right now, and no builders that geeked up and excited to build right now, just because a tariff situation going on, interest rates, uncertainty, materials, and then in some markets there appears to be a little bit of a potential oversupply, and so that volatility is what's making it really a good time to get into rentership and buying things that you can rent out. So I think BTR has probably 3 to 5 good years left before these properties, which are all relatively new, are going to start aging. Number two, at some point, it will become affordable to buy homes, and that would prompt maybe less occupancy. And I think some people start exiting, like some of these institutions who've bought these a couple of years ago, now will start exiting their cycle. So I get a sense of that, but right now I think it is really a good time. And right now cap rates are compressed in traditional value add, David. So our strategy, which we've studied for almost 10 years, we started our company in 2015. It's 2025 now, 10 years in the business. We've focused on just one thing, which was value add multifamily. We've gone up into core and core plus, but still multifamily. We're not seeing that amazing opportunities besides like a cherry pick. I mean, we probably underwrite 2,000 to 2,500 deals a year, of which 5 makes sense for us. So that's why looking in BTR, where man, the numbers actually, there's cash flowing day one. There's some growth opportunities. They're in good markets, good demographics. There's a renter preference for this kind of asset, so that's what we're doing it. And the second thing is, when it's a bad time to buy existing properties, maybe it's a good time to build. And so we've had someone on our team that we acquired maybe about 2 years ago. His name is Ed. He's an asset manager. And in his previous firm, he was also a developer, and they developed almost $1 billion of multifamily. And so he's been sort of a nice little addition to our team. And what we've found is there's, if you're able to lock in supplies and labor and certain things in your contracts, and you can get land at a decent price, then there's an opportunity to really take advantage of development. And we're doing this right now in an area of Phoenix called Peoria, which is a nice submarket. It's of Phoenix, and there was an oversupply in Phoenix as well as in Austin and a lot of other markets, and that supply is essentially burned off by this year, or definitely last year, and then this year, and then essentially supply falls off a cliff in most places in the country. So we think when we go vertical in 26 and probably more like 27, that will be in a perfect time to release this new product that can compete. No new supply coming online. At that point, rates will have dropped, rents will have recovered, and I think we're going to be in a good position. So a Viking strategy really is, hey, don't let go of your core focus, which is multifamily, but expand into build to rent and then add development where there's certain market cycles where developing it's actually cheaper to develop than to buy existing properties.
Interesting. I wonder if you can, for folks who still maybe don't fully understand the build to rent strategy, at least insofar as being a property manager of like actually the strategy for holding on to these assets for a while. Can you just talk about the sort of efficiencies or the ways that you're able to sort of maximize your investments in these types of properties, by owning a whole community together?
Sure. If you own like a single family home and you rent it out, when that person leaves, then you're in trouble. And obviously you can offset by doing a duplex or a quad, right? But imagine if there's a way to do a 116 plex, and that's exactly what a BTR is. And so our first one we bought was in Dallas. It's in a community called Waxahachie, just in the suburb of Dallas, and I think it was 116 units, I believe, and it was beautiful. It was built maybe 2 or 3 years ago. And then the builders had struggles. They wanted to sell it earlier, but they couldn't because of all the market cyclical nature. Then they were able to finally sell it. And we got a really good basis, and that's what got us excited. The second thing we really liked is the sort of the cash flow that came with the deal. But there's not much to be done in terms of maintenance for us, and so we like that because it's essentially was only thing 2 years old or something. So, and then once people move into these places, it's a different mindset than an apartment. In an apartment complex, maybe you leave in 6 months, maybe you leave in a year. But these people, it's a 2-car garage in all these places. It's a nice walking community. You can walk your dog. There's a yard. You probably get to know your neighbors because people go outside. So it feels like a real community. It feels like a home, not like just a rental. And so and it's right across the street from a big hospital system. So a lot of nurse practitioners, maybe young doctors, maybe, techs. And so it's a workplace live community. You can have 2 cars there and be totally fine. You can have a garage. There's barbecues. And so people enjoy that kind of thing. And so we believe this is what renters want moving forward. And maybe this is the next level evolution of renter. You have the blue collar renters and B and C properties. You have sort of the young single professionals in the A class properties, and now we have the families who want to rent long term, perhaps in these BTR communities. The last thing, there's efficiencies. So when you have that, you'll have a property management company that will manage the whole thing, but they'll keep since every house is essentially identical, with some slight variations. You keep mass supplies, and so whatever you need to swap out, you swap out. Maintenance you can swap out, but it's interesting. These people, they don't view this as an apartment rental. They view it as their home, and so if there's a light bulb, they'll probably replace it themselves versus calling us. Or, there's certain things that they'll do on their own because it's their home.
Right. Yeah, it's a totally different mindset. I wonder, you yourself were a practicing physician, and you managed to transition to this place where now you're spending time actively and passively investing in commercial real estate. But you've also diversified your income streams in a variety of ways. One of the things you do is you coach other physicians to help them figure out how to achieve the sort of freedoms that you have in your life. I wonder if you can just talk a little bit about what your process was, how you got from, med school essentially into this career that you thought, okay, this was the plan, right? And then decided maybe there's something else around the corner. How do you make that transition? And I also wonder if there's anything that you would say to other physicians who are thinking, man, this guy's crazy. I don't have time in my life to start thinking about this stuff.
I think I have to honor the generation of doctors that came before us. They were really married to medicine as essentially a way of life, and their identity was really intertwined with being an MD or a doctor. And we salute them, and they're the ones who trained us, growing up. That being said, our generation seems to have evolved. I think there's a new breed of physicians out there, David, and this new breed of physicians, they sort of want it all, and they do want to earn a strong income. They do want to serve their patients, honorably. They want to have an impact on their communities, but they grew up with a lot of other passions and interests: playing the piano, writing books, hanging out with their children, traveling the world, doing medical missions, like all sorts of things. And so some of that relies on free time and more disposable capital. And instead of just waiting till we're 75 or 80 to retire and then maybe have a few years to pursue those things, the problem with that is, there's a really great book out there called Die with Zero. And it really talks about there's a health curve and a wealth curve, right? And the wealth curve keeps going up, 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 up. and then the health curve slowly, starts dropping down. And there's a point where after the two lines cross, additional amount of wealth is almost unusable because you don't have either the time or the health vitality to even go after the things you wanted. And so the goal perhaps is, one, we want to make sure you stay as healthy as long as possible. That's one of the things we teach. It's biohacking and anti-aging and vitality strategies for sure. But part of that is, why wait? See if you can start taking these mini vacations, mini retirements, sabbaticals, or you go from a 5-day work week to a 4-day work week. No one's saying anyone needs to retire from medicine, but can you practice on your own terms? And that language pattern seems to resonate with so many doctors out there. Hey, I want to practice on my own terms. And so that was what drove me. So as a cardiologist practicing full time, 60, 70 hours a week, I started getting, burnt out from the rat race a little bit, but I really enjoyed patients, and I thought must be a better way. So I really wanted to practice in a different way called functional medicine, integrative medicine, by anti-aging and stuff. And so to do that, it was sort of risky. And so I thought, hey, why don't I learn real estate as a means to helping me diversify my income so I can go pursue my passions? And what ended up happening with the side hustle became my main hustle. So
classic.
Yeah. So I started with single family homes. My first home was a $28,000 house in fix and flip in outside of Atlanta. And now, like this Peoria project, this new development we're going to launch, it's 60 million, for example, that we're going to launch. So it's crazy how things have evolved over time. But part of that is having a team. Part of it is having a vision. Part of it is having so many people. I'm standing on the shoulders of so many people, so many giants that have helped me get there. People have poured into me, and now I have that privilege at least to pour into others and help them. And so, yeah, our coaching program is called Limitless MD, and we really help doctors do three main things. Scale their clinics. Number 2 is pursue some kind of entrepreneurship side hustle while still practicing. And number 3 is if they're interested in things like real estate, we help them either active, passive, or actively passive, and those 3 strategies. But we want people we want to empower these doctors to live their best life.
Incredible. You talk about having a team that you work with in order to achieve some of this success. Can you just sort of talk about how you built that team? Who you were looking for to help you achieve your dreams?
So we're trained as successful professionals to be like, if it's to be, it's up to me, which is a really good self-reliant mindset. But at some point, as Kiyosaki eloquently puts in his cash flow quadrant, you have the E, the S, the B, the I. Most of the money, is on the right side of the quadrant, and to do that, you can't just be trading one input for one output. And Naval Ravikant, the famous tech philosopher, always talks about leverage, and he talks about the 4 forms of leverage: labor, capital, media, code, or AI. And so I was like, how can I start using this? And so the first simple thing is hiring, teams. And so probably the first thing for all of your listeners would be, if you don't have a virtual assistant, probably get one of those, maybe an executive assistant. And then if you're in a clinic, for example, or a professional, maybe having an office manager or someone actually manage the business operations of whatever you're part of. If you're in real estate, you should maybe have someone, outsource the underwriting to somebody, outsource, the property tours or something like that. And the other thing is this: having partnerships. That it's a sticky situation. It can sometimes be scary to have partners, and sometimes very challenging because it's sort of like a marriage. But it can also be very profitable, and it can allow you to grow quicker. So it's a mixed bag. But if you find the right partner, it can really help you. And thankfully, knock on wood, I've had really good partners in both my companies, Viking and Limitless, and that's helped. And I'm sure your company, Equity Multiple, it's based on teams and strategy and partnerships and a common vision.
Absolutely. Okay, well, I feel like the one thing that we haven't talked too much about from an investor's perspective is the question of diversification. And I think it might be easy to think, when you're thinking about a build to rent sort of approach, if you're investing in 120 homes in one neighborhood, in one city, that might feel like putting all of your eggs in one basket. Can you talk about how you think of about diversification and making sure that, you're sort of hedging any potential risk, be it a geographic risk or a market risk?
I'll give you my personal example. So I think I've invested in probably, you know, I probably have like 85 income streams if I could just talk about all the different investments I've put in, right? So I've invested in, things like, Neuralink and SpaceX, and there's probably not a cash flow stream there, but I'm excited about the potential of what, those pre-IPO stocks can eventually do. But it's something I believe in, I understand, and makes sense to me. And so, sure. I've invested in stupid things like, when the CBD hemp farm popularity happened. And so I'm a proud owner of a piece of dirt in Colorado that's not producing any cash flow, and I probably will not get my principal back.
Right.
And that's understandable. One of my coaching clients, I won't mention her name, so I won't embarrass her, but she invested in a cattle farm in Texas somewhere, and she lost her money. So, I mean, we all do stupid things. That's fine. But that's why you don't invest the whole nest egg, right? You invest, a smaller portion of the money. But okay, so there's a BTR deal. So if I invested 50K, yes, my money is locked into that 50K of that investment. But if I also put 50K in I don't know, oil refinery in Texas, I also invest 50K in an apartment complex in downtown Atlanta or next to the NIH, whatever, or I'm sorry, the CDC in Atlanta. And then I also put 50K in, a car wash in, Raleigh, North Carolina. Then I'm showing some diversification. There's a dark side to diversification. If you diversify too much, then you lose the competitive edge of having some sort of mastery. And it really becomes a crapshoot then. So there is probably a sweet spot to diversification, and there's maybe an overkill on too much focus. So you may want to find that. I really like real estate, and I've understood it, and I invest in it pretty carefully. But I don't really invest in operating businesses because I don't understand them. I don't invest in outside of my own. I don't invest in I did make a mistake of investing in a car wash and it didn't work out well. But in general, 90% of my money is probably in real estate because that's what I understand the most, and that's what actually focus is really the competitive advantage for me. Because I know the nuances of this industry inside and out, and it will probably, and if you notice, Jeff Bezos, for example, all his wealth was made from Amazon. Once he made it big and he sold shares, then he started buying the Washington Post and I don't know, sports teams and all the other stuff. But you have to make it big with something with specialization, and then you can diversify for safety. But the moment you diversify, the returns go down because you don't have the competitive advantage.
I think a lot of investors that are interested in multifamily, as we've said, maybe they understand the basic sort of value add deal. But something that you guys are engaging in now is actually ground up development. That's, from the planning phase and permitting through the actual construction of these assets. I wonder if you can talk about, how you decided to get into that. I think some investors might think that feels like a more risky play. Obviously, that's a longer term investment. You're sort of you're going to have to deal with all of the logistics of construction and then lease up. So talk to me about getting into development and why you feel like that's the right move right now.
I think there are times where development makes a lot of sense, and if it wasn't so lucrative in some of the cycles, probably people would never do it because it's so risky. But there's a way to mitigate that risk, and so I was never interested in development for many years because it just didn't make sense. We didn't have the expertise, and it seemed like just a different animal, And so what we've done is, one, we've brought on internal team members who've had that experience. One of our asset managers I mentioned named Ed, he's developed $1 billion of real estate, and he really understands the space. And now he's inside our company, which is helpful. Second is until we master the skill set, we want to partner with people who've already done this. Like it's what they do. It's their specialization, right? And so we partner with another group who are local developers in the Utah and Arizona areas. And so a lot of the risks are entitlement risk. It's getting the land, it's getting the permits. And so what we've done is we've strategically entered the relationship once those have already been done. And so that's powerful. And number two is we have these we do extensive demographic and other types of studies when our new starts happening, when our completions happening, and we try to really map out the volume of construction in an area before we even consider joining. And so in this particular example, Peoria, which is a rapidly growing submarket of Phoenix, we found an area where there's definitely a need. Supply falls off a cliff in 2025, essentially. And by 2026, 27, there's going to be essentially no new starts or no new construction. And it's rapidly growing. Like, for example, all the Cactus League, which is MLB, plays, I guess, spring training.
Oh, right.
A lot of the spring training happens in Peoria, for example. And so I didn't realize that. So all the major teams come there. They're building a brand new aviation park for private jets, $1 billion development there. Mattel, the toy company, is doing sort of a Universal Studios like theme park they're building there. So it's a lot of cool stuff. And then, as you know, Taiwanese Semiconductor as well as Intel they're building a lot of chip factories. And so we believe in the economic story, at least. And the other thing is, I got scared of Phoenix because I remember in 2008 they got killed. But it's interesting. The Phoenix of 2025 is different than the Phoenix of 2008. They really diversified. They have a good healthcare economy, Mayo, Arizona, and all these companies. So they've really diversified. It's not just sort of a halfway city. It's really become a full-fledged city with sports teams and different industries. And so I think it's selection of the right city, it's selection of the right partners, it's selection of the right timing. And I can't emphasize the timing enough. If you can get the timing correct, then you can do quite well. And traditional multifamily right now, with cap rates are compressed, and so we're not necessarily getting deals. Insurances are a challenge, taxes are a challenge. Labor to find, to staff these apartments are a challenge, and so sometimes it's nice to find opportunities where you can control most of the variables, and then upon completion, you have a nice return for your investors. And so the cool thing here is, yes, there's no yield, because you're building it, you're not renting it out. But in 24 to 36 months, you can essentially have a 2x, investment, IRRs in the 16 to 18 range with relatively mitigated risk.
Right. And of course, that's, with development, that's always the caveat is your money's going to go in and it's going to get locked up. That's just how it works because, of course, you can't rent a plot of land. You got to build the building first. Right. When you go through the lease-up phase, is that something that you guys are going to engage in as well? Does the business plan? Yes,
that's our specialty. We're really good at lease-up. We know how to do it very well. We have the expertise, and also we'll be bringing our property management company that we've been working with for all our assets there. And so we have a strategy in place. And so one of the things is, instead of waiting to build all the buildings and then doing a lease-up, as each building goes up, we'll start leasing it up.
Right. Sort of a rolling lease.
And the cool thing is, as there's more EV vehicles now, there will be EV chargers here on this property. We're also putting solar on the part of the roof to take care of the common amenities. There's pickleball courts, cyber cafe, dog park. So these are the kind of places that people want to live in, as people move forward.
Sign me up. I'm moving to Peoria. Vikram, I really appreciate you taking the time to join us on the show today. Thanks so much.
Thanks, man. Appreciate it. Really enjoy speaking, and if the investors or listeners are ever interested in finding out more about what we have going on, they can go to our website, vikingmultifamily.com.
That's it for this episode of Multiple Perspectives. Thanks again to Vikram for joining me. If you enjoyed today's discussion, I'd encourage you to follow our show or subscribe to this channel, or sign up for an account on equitymultiple.com. Any of those methods will ensure that you know when we release a new episode. If you want to hear more about what Vikram has to say on personal finance or real estate investing, you can find links to his work in the show notes for today's episode. If you want to learn about the real estate investing opportunities that we have on the Equity Multiple platform, of course, we've got links for that too. Thanks for joining me once again here on Multiple Perspectives. I'm David Lofgren, and as always, you can let me know what you think of our show via our email, multipleperspectives@equitymultiple.com. See you next time.